In this video, we shall get acquainted with the concept of taxation. We need a government for the security of our country, maintaining law and order, for public welfare, building social infrastructure like health and education, etc. In order to provide all these services, government needs revenue. Government has the sole privilege to tax its citizens and spend that money for the above stated purposes. So in what ways can the government tax its citizens? The government taxes its citizens in two ways. One, on the income of individuals and corporate entities, and second, on the sale and purchase of goods and services. The first type is known as direct tax and the second is known as indirect tax. Direct tax includes the income tax, which is taxed on an individual's annual income, and corporate tax, which is taxed on a company's annual net profits. Indirect tax includes the GST, which is taxed on the supply of goods and services, customs duty, which is a tax levied on imports and exports, etc. Excise duty and service tax were subsumed in the GST in 2017. Let's understand what is incidence and burden of taxation. Incidence of tax is the intended person or entity whom the government wishes to tax, and burden of tax is who actually ends up paying the tax. In direct tax, both the incidence and burden is on the individual or the corporate entity. So they are taxed for their income and they themselves pay the tax. So it is called a direct tax. But in indirect tax, for example the GST, the incidence is on the seller, but the buyer ends up bearing the burden of taxation. So consumer pays it to the seller and seller in turn pays it to the government. Hence it is called as indirect tax. The center has the power to levy direct taxes like personal income tax, corporate tax, and indirect tax like GST, customs duty, etc. States are also part of deciding the GST rates as they get a representation in the GST Council. Additionally, states can have value-added taxes on petroleum products and liquor. State can also levy a direct tax in the form of tax on agricultural income. Please note that central government cannot levy a tax on agricultural income as according to the section 10(1) of the Income Tax Act, agricultural income is not considered a means of income. However, states can tax agricultural income above the exempted rate, which is Rs 5,000 in a fiscal year. Presently, 6 states in India have legislations to tax agricultural income. Which are these 6 states? Please let me know in the comment section.